Good day, everyone, and welcome to the premium video newsletter for July 19th, 2013. It's been an interesting week, to say the least. There were no fundamentals released today, but there were several earnings reports. Disappointing results from Google, Microsoft, and the chipmaker Advanced Micro Devices weighted heavily on the stock indexes this morning. There were some clues that the market was going to turn down today. The first clue was the negative earnings from Intel, which is a very strong barometer for tech stocks. Second, the semiconductor index was very weak yesterday as a whole. I warned that if the gap is going to be filled, we should expect some more downside momentum. The gap was in fact filled this morning, and the technology sector is putting strong pressure on the U.S. stock indexes. Looking at the energy market, signs of improving U.S. economy has helped push the price of oil to the highest level in 16 months. Oil prices have gained support from improved hiring and manufacturing activity in the U.S. A sharp drop in the nation's crude oil supply, signaling an increase in demand, has also boosted energy prices. The volume was high and the market was very volatile, but it's showing me that there's still strength left to move up to the 110 level in the very near term. The dollar softened against the euro in quiet trading on Friday, as investors speculated that U.S. monetary policy will remain flexible for the long term, even after an eventual Federal Reserve decision to taper its stimuli program. The program, such as the Fed's monthly $85 billion bond buying program, weakens the dollar to spur recovery. Although Chairman Bernanke said earlier this week that the end of the stimuli measures, which aren't bound by a timetable all of a sudden, won't be herald the arrival to tighten policy. While the dollar firmed in recent sessions on sentiment that the stimuli programs are on their way out in a matter of months to a year, the currency weakened on Friday on expectations that the Feds will take its time unwinding such policies and may even delay such a decision should economic data disappoint. Technically, the dollar does appear to be setting up for another move down. I've been anticipating this for a while, as most of you are aware, and it looks like we may start seeing a breakdown as early as middle of next week. It seems that if we can clear the 82.5 level to the downside, we may see a nice sell-off to the 80.5 level, which is my target. The miniature triangle pattern to the downside looks like it could be a good signal, and I will notify you if we break this level in the coming days. Since volatility is rather low today, and most world markets are not doing too much, I wanted to take the time to answer a question from one of our subscribers. I try to pick questions that are asked numerous times, and I have a good one today that some of our subscribers have been asking me for the last few weeks. Traders wanted to know why none of the strategies we present have stop-loss levels that are moved to break-even positions after there's a profit buildup in the trade. Just so everyone is on the same page, many traders like to start off with a normal stop-loss that's based on volatility, dollar level, or chart pattern level, but as soon as the position gains some ground, the trader moves the stop-loss to break-even level to eliminate any risk from the trade. This is a very common method for controlling risk. However, there's a fundamental reason why I don't move my stop-loss levels to break even. Your risk level is completely correlated to your percentages of win or loss ratio. In plain English, the tighter your stop-loss level, the greater the risk of being stopped out, and the wider your stop-loss level, the less chance you have of being stopped out. By trailing your stop-loss, which is a technical term for moving the stop-loss closer to your position, you increase your odds of being stopped out because the trade has less movement to randomly move around and develop. My backtest results actually show that moving a stop loss to break even decreases your percentage of profitability by about 12.5%. So you'll have more risk control, but you will also have more trades being stopped out. If you're stopped out, you miss trading opportunities that can potentially make you a lot of money. So to me and most professional traders, missing an opportunity by being stopped out prematurely outweighs protecting my initial risk capital on the trade. So it's a trade-off, and if you have a method that produces good-sized winners that are substantially bigger than your losers, as we have here, the missed opportunity will cause you more loss than protecting initial risk capital on the trade. There's another saying for this: penny wise and dollar foolish. There's no setups today, and I will update you Sunday night or Monday morning. Have a great weekend, everyone.